The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Welcome to Nova 401k Associates webinar on 401k loan and distribution basics. We have also added the slides as a handout. Just click the handout drop-down on your GoToWebinar panel, and you can download and save the file to your local folder. If you have any questions, please type them in the questions box, and we will go over them at the end. I will now hand it over to Jason Worms.
Thank you, Jasmine. Took me longer than I expected to get off of mute there. Welcome, everybody. Thank you for taking time out of what I'm sure is a busy Wednesday afternoon to come and learn along with us about 401k loan and distribution basics. My name is Jason Worms. I am a team leader here at Nova 401k Associates. I actually lead our multiple employer plan team. Just to kind of give you a little bit of background on me. So let's dive in. So first, our general disclaimer. Nothing in this presentation is intended to be tax advice or legal advice. The information that we share here is designed to be general in nature. As always, we prefer if our clients and interested friends consult tax attorneys, tax accountants, or ERISA attorneys if you need legal or tax advice. If you are attending this webinar for CPA credit for the state of Texas, our provider number is 009820. You need to have registered individually for this webinar. You have to be present for the entire webinar. You have to complete an evaluation form at the end, and then it takes us about a week to get the certification forms completed and sent out to you. So please be aware of that if you are attending for Texas CPA credit. Okay, so what are we going to be talking about today? Distribution basics is the big one. So we're going to be talking about all kinds of distribution types, including the new COVID-19 distributions that are in effect for this year. We're going to be talking about tax notices, special taxation issues with distributions. Then we go over to participant loan basics, talking about loan amounts, also up to date with the COVID-19 information, talking about defaulted loans. Then we're going to be talking about vesting of employer contributions in participant accounts and how that ties into distributions and loans. We're going to talk a little bit about some of the most common problems that plan sponsors, participants have with distributions and loans and how to prevent them from being problems in the first place. And then we're going to wrap up with a quick discussion of cybersecurity because as we are going to more and more remote work, this is becoming even more of an issue than it already has been. As Jasmine said at the open, please feel free to submit any questions that you have through the chat box. We are planning to do the questions at the end. So if you do have a question about a specific slide, we do have slide numbers here hidden in the little dog on the bottom right. But if you mention the slide number with your question, it will make it a lot easier for me to answer when the time comes. All right, so when you're done with this 50 minutes with me, you should be able to understand the mandatory and optional distributions that can be made from your 401k plan. You should be able to identify the loan provisions and the loan requirements in your plan. And you should be able to understand how vesting applies for loans and distributions in your plan. And if you can't do those things, that either means that I have put you to sleep or I didn't do a very good job. So let's hope that we get all three of those bullet points before we wrap. So distribution basics. Once money goes into a 401k plan, it's designed to be a retirement plan, right? So there have to be specific requirements that have to be met before the money can be withdrawn. The first one, and probably the most common, is if you terminate your employment or if you retire from your job, that is an opportunity for the participant to take their funds and do with them what they like. Okay, this is probably going to be the one that happens the most frequently for plans, and so that will be a nice easy one when we talk about the rules for that. Another one is age 59 and a half, which are known as in-service distributions. So participants who reach the age of 59 and a half might be able to take a distribution of their account. It depends on each individual plan. We're going to be talking more about that later. Another way of taking money is by taking a hardship withdrawal. And again, we'll talk about the specific requirements for that later. Death and disability, so if a participant passes away or if they have a total and permanent disability, there's an opportunity for them to take funds out of the plan there. And then we can also talk a little bit about the ability to distribute rollover funds from a participant account. So we're going to go through all 5 of these in a little bit more detail on the next couple of slides. Before we get into those, though, I wanted to address the elephant in the room, which is the CARES Act. So if you have been living in a quarantine bubble and unable to access the internet or outside information of any kind, you might not have heard of this, but there is the CARES Act, which was passed by Congress, signed by the President earlier this year, which allows people who are impacted by COVID to take a distribution of their account balance. There are some rules around this that we're going to go over here in a moment, but that's kind of the background for this. So in order to take one of these CARES Act distributions, you have to meet one of the following criteria. As a participant, you, your spouse, or your dependents have to be diagnosed with COVID-19 or SARS-CoV-2 by a test approved by the CDC. If you're a participant who experiences adverse financial consequences as a result of a quarantine, furlough, layoff, reduction in work hours, business closure, lack of childcare, or other factors determined by the IRS due to the coronavirus emergency, you can also take a withdrawal. Now, if you're a plan sponsor and you're thinking, how in the world am I going to know if my participants have any of these things? Good news for you. The plan sponsor can rely on the participant's self-certification. So if a participant comes to you and said, I've been diagnosed with COVID, they do not need to provide you with a positive test. You are able to rely on their self-certification that they had COVID to qualify them for one of these withdrawals. Okay, this is different from your hardship rules where we do have to see that backup. For the COVID distributions, that documentation is not required. The participant bears the burden of having that documentation. Okay, so if a participant comes to you and says that they meet one of those criteria, they are allowed to take up to $100,000 across all of their plans or IRAs as a COVID CARES distribution. Okay. Now, note that the limit is $100,000 in total across all of the retirement plans that they are a part of, all of the IRAs that they have. That $100,000 is total. So if you have a participant who has $200,000 in your plan and $200,000 in another plan, they cannot take $100,000 out of each. It's $100,000 in total that they can take as a distribution. If they have a vested account balance that is less than $100,000 across all of those plans, then they can take up to their full vested account balance. Okay. Qualifying withdrawals can be taken on or after January 1st of 2020, but have to be taken before December 31st of 2020. Okay. Based on how you read that regulation, reasonable people can come to different conclusions about whether the money has to be out by December 31st or if the distribution has to be requested by December 31st. NOVA's position is always the more conservative one, which means that the money should be out by December 31st. So, that's that. We just want to make sure that we're in compliance with the IRS rules on that. Okay, so when you take this distribution, the withdrawal will not be subject to a 10% early withdrawal penalty if the participant is under the age of 59 and a half. So that's good news for the participants, saves them a little bit of money come tax time, which is good. The distribution is also not subject to the 20% mandatory tax withholding. So distributions that are eligible for rollover have a 20% mandatory federal income tax withholding applied to them. These CARES distributions do not have that requirement. Okay. Income taxes are due on the distribution, but they can be spread out over 3 years unless the participant elects otherwise. There hasn't been a lot of guidance from the IRS on this yet, but the expectation is that the tax is spread out ratably. So 33% of the tax would be due in the year of distribution, 33% the next year, 33% the third year to get to 100%. And I guess one of those would have to be 34%, but hopefully you get my drift. So in addition to the 3 years to claim that on their taxes, participants also have 3 years to repay the distribution to the plan if they choose to. It is not a requirement to do so, but that option is there if the participant takes the money, either determines they don't need it or they do need it and use it, but then are able to scrape together the amount that they took and want to put it back towards their retirement. The repayment can be made to any plan or IRA. It's treated essentially like a rollover contribution. So it goes into its own rollover source. But if the amount that they return to the plan has already been claimed on their taxes, they would need to amend their tax returns for that year in order to make everything on the up and up with the IRS. No one has actually done this yet that I have seen. My guess is we probably won't get to any people repaying these funds until later this year at the earliest. But you definitely, if you have a participant who wants to make a repayment of these funds, you want to make sure that you're working with your record keeper to make sure that all this stuff goes in the appropriate way. Okay, so that's the quick rundown of the CARES Act distributions. So now into the kind of the more plain vanilla distributions, the termination of employment or retirement distributions. These are distributions that are completed by the participant at their discretion. So if a participant terminates employment or retires, they can choose to come and take the money, or they can choose to let it sit there for a limited period of time at least before they take their distribution. The plan document, your individual plan will tell you how quickly after termination of employment a participant can take a distribution. Most plans allow participants to take withdrawals as soon as administratively feasible after they terminate. It is worth noting, however, that depending on when a person terminates, it could be a couple of weeks before their final payroll contribution is actually made to the plan. And in order to minimize the fees that are assessed to the participant's account, etc., we probably want to wait until that final payroll deposit is made before that distribution is sent in for processing. So as participants are clamoring for their funds, I know it can be hard to put the brakes on, but you do want to make sure that their last payroll deposit has been sent in before you approve that distribution request. Okay, another thing that if a participant is terminated, they can have an involuntary force-out distribution. So many NOVA clients have already gotten communications from us this year about what we call force-out distributions, which is requiring participants who have terminated employment and have vested account balances of under $5,000 to take the funds themselves within a specific time frame, and if they don't, then the money is going to be rolled over to an IRA on their behalf. So this is kind of the more of the regulatory background of where all that comes from. The IRS has two limits that you can impose on forcing participants to take distributions out of the plan. The first one is $1,000. The second limit is $5,000. And we'll get into what those two limits represent here in just a minute. So if you have a vested account balance between $1,000 and $5,000, the plan sponsor is required to set up an IRA on the behalf of that participant before they force them out. And then that force out goes to the IRA on the participant's behalf. The participant has 30 days from the day that the day that the plan sponsor tells them that they need to take their funds before the distribution can be processed. We want to give the participants up to 30 days to come and claim the funds themselves and either take the distribution in cash or roll it over to an IRA or a qualified plan of their choice prior to being forced out into an IRA that the company has set up on the participant's behalf. Okay. Most NOVA clients use NOVA IRA for their IRA rollover provider, but NOVA does work with Millennium Trust and some other rollover providers out there. So if you have questions about yours, don't hesitate to ask your NOVA account manager, and we will be able to get you straightened out with that. Now, for distributions that are under, where the vested account balance is under 1,000, the plan sponsor has the option to either set up an IRA on that participant's behalf and roll it over there, or they can also, or alternatively, pay the distribution to the participant in cash. Okay, if the distribution is paid to the participant, 20% tax withholding is required, so they'll get 80% of their account balance, and the other 20% will be sent to the IRS for federal income tax. NOVA, as a general rule, encourages our plan sponsors to do rollovers to IRAs, no matter what the account balance is for their terminated participants. We think that that is less administrative work for our plan sponsors. And the reason why we think that's less work, I got an email just today, actually, from a plan sponsor who had paid distributions under $1,000 in cash to a handful of participants, forced them out of the plan, and the participants have never cashed their checks. And here we are 2-3 years later, and they can't find those participants, and these checks are sitting out there, and they're still money that they have to pay attention to and keep track of and try and find these participants. Whereas if the money is rolled over to an IRA, it now becomes the IRA provider's responsibility to track down those participants and get them to claim their funds rather than the plan sponsors. So because of that administrative bit of efficiency, NOVA encourages our plan sponsors to do rollovers for all of our account balances that are under 5,000. Okay, let's see, and that's what I was just talking about. Okay, apparently I was a slide ahead, but here in writing is what I was just saying. Okay, to our next distribution type, which is the age 59.5 in-service withdrawals. This is an optional provision, so plans are not required to allow participants to take distributions of their accounts while they're still employed. It is entirely optional. There are many plans that choose not to do this, just like there are many plans that choose to allow these distributions. You can restrict the money types that are allowed for these distributions. So you could say, for example, I want participants to be able to take their 401k deferrals, but I don't want them to be able to take the employer match that we put in on their behalf. We want that to be towards their retirement, et cetera, et cetera. They have a whole bunch of different combinations of how you can restrict the money that comes out of here. Because the distributions are, the participants are over the age of 59.5, the early withdrawal penalty, the 10% early distribution penalty does not apply. So that's good news. But the distribution is subject to federal income tax. So if the participant takes it in cash, the distribution that they take will have to be included in their taxes for the year of distribution. Obviously, if they roll over their account, there would be no taxes that apply to that. Okay. Next up is hardship withdrawals. Again, like in-service withdrawals, this is a voluntary provision, so it is not required to be in the document. But what this is it allows participants who hit a rough patch access to their 401k. So it doesn't require a person to be over the age of 59.5. If they meet the qualifications, then they are allowed to take a withdrawal. The withdrawal is still included in their taxes as income and would be subject to the 10% early withdrawal penalty if the participant is under the age of 59.5. Like we talked about, or like I had mentioned, the hardship, the participant does have to prove their hardship and provide that documentation to the plan sponsor before the distribution can be processed. So the reasons that a person can take a hardship withdrawal are listed here on this slide. Most of them have to do with the primary residence, right? So purchase of a primary residence to prevent the foreclosure on or eviction from the primary residence. Casualty losses against your primary residence is what those typically are. Another big one is unreimbursed medical expenses. Post-secondary education is a big one this time of year as tuition payments are coming due. Burial expenses, and then there's a newer one where hardships incurred as a result of a federally declared disaster are also hardship reasons. Now, it's worth noting that hardship withdrawals cannot be reimbursements. They have to be paying for an expense that has not been paid yet. So you can't have a participant that comes in and gives you a invoice that they have already paid for unreimbursed medical expenses and then get reimbursed for that. Okay. What would need to happen is they would need to provide you with a statement or a bill from the medical provider or whatever and say, I need a hardship withdrawal in order to pay for this bill. Okay. So the distinction is subtle, but it is important because distribution requests do get rejected if the participant is trying to submit a bill that has already been paid. Okay, and that can cause a lot of consternation and hard feelings between the participant and the plan sponsor and NOVA and the record keeper, and we much prefer everyone to be happily on the same page. Okay, hardship rules changed pretty significantly in 2019, and because hardships are not necessarily that numerous for plans, we wanted to take some time to go over them. So some of you may have remembered that back in the day, in order to take a hardship withdrawal, you had to take all of your available participant loans from the 401k plan first. Okay, this is a way for Congress to say, you know what, for a hardship withdrawal, we want you to get your money from all other sources first, including from the plan in the form of a participant loan, before you could take a hardship withdrawal. Congress has since kind of changed their mind on that and made things easier. So you no longer have to take a loan prior to getting a hardship withdrawal in the plan. That change was effective January 1st of 2019. So all of 2019 and so far in 2020, that new rule has been in effect. Also, in the past, hardship withdrawals, you could not take the earnings on your 401k deferrals as part of the hardship withdrawal. You can only take what's called the basis, or the amount that was actually contributed. That is no longer effective either. Now you can take not only your contributions, but your earnings on your 401k deferrals or your Roth deferrals when you take a hardship withdrawal. Another thing that was a headache for plan sponsors was you used to have to stop employee deferrals for 6 months after a hardship withdrawal has been taken. As almost the thinking behind that was, well, if someone's really in that dire of a financial strait, we should stop their deferrals to the plan to give them more cash so they can get out of their hardship. But that rule has also been repealed, so participants can take a hardship withdrawal and continue their deferrals if they choose to. So NOVA updated our plan documents to accommodate all these changes before the end of 2019. So they were in effect for the majority of our clients and have been since then. So talking about hardships, I had mentioned this earlier about in-service withdrawals. You can choose which money types within the plan are eligible for these hardship withdrawals. So you can have hardship withdrawals able to come out of employee deferrals, but not out of employer match, so on and so forth. In the past, safe harbor contributions, QNET contributions, qualified matching contributions were not available for hardship withdrawal. Again, effective in 2019, those rules were changed. So those contribution types can now be taken for hardship. They do not have to be allowed for hardship withdrawal, though. So just be aware that if you are a safe harbor plan and you're used to having your participants only being able to take their 401k deferrals for a hardship withdrawal, the new rules allow you to have them take money out of their safe harbor accounts if you want to. Okay. All right. Next up, talking about rollover money. So rollover money is when a participant has an IRA or a 401k plan somewhere else, and then they move those funds into your 401k plan. We call that a rollover money type or a rollover source. If you have one of those, then the plan documents say that you can take a distribution of that money only whenever you like to. Okay, so for example, if you're 20 years old and you have a 401k from a previous job and it's got $1,500 in it, and you roll it over to your new 401k plan, you could take that $1,500 out in cash right at the age of 20 without any restriction in the plan. Now, that does still count as income for the participant for the year in which the distribution was taken. It still would be subject to the 10% excise tax for being prior to the age of 59 and a half, but it is a way to have access to your funds and do a rollover into your current plan if you so choose. So it's kind of a little bit of a carrot to encourage your participants to consolidate their retirement funds in your plan by granting them access to those funds should they need it. Okay, death distributions are next. So it's always unfortunate when a participant passes, and it is really unfortunate if a participant passes and there is a struggle or a disagreement or what have you over the deceased person's retirement account. So what has to happen, or a best practice, is if you don't have a beneficiary designation from all of your participants, you really should get one. Record keepers sometimes track this information, but ultimately it is the plan sponsor who is responsible for keeping track of who the designated beneficiary is for each participant. It is also worth mentioning that the beneficiary designation that is on file does not automatically get updated due to life events such as marriage or divorce. Okay, so it is important to make sure that when a participant of yours has a life event like that, or the birth of a child or something like that, that they update their beneficiary designation to make sure it stays current. No one really likes to have these conversations because they can seem a little bit morbid, but they really, really, really save a lot of consternation for the beneficiaries of your participant if they've been had and if those documents are updated timely. So to take a distribution due to a participant's death, you do need to collect a copy of the death certificate. Believe it or not, there have been requests made from people who claim to be beneficiaries of a person who they say has died, and it turns out that the person hasn't actually been dead. Okay, so it may seem ridiculous, but these things are out there, which is why a certified death certificate has to be submitted along with those distribution forms. In addition to that, we also need you as the plan sponsor to confirm who the beneficiary is before a distribution can be processed, because we want to make sure that we're not doing a distribution to the participant's sister, for example, and then the spouse shows up a week later asking for the funds and they're already gone. Okay. So again, it's extremely important. I cannot overemphasize how important it is to have up-to-date and clearly delineated beneficiary information in your files for your participants. All right, talking about minimum distributions next. We're going to go through this one a little bit quick just because the CARES Act actually eliminated the required minimum distribution requirement for the 2020 plan year. So if you have a participant who is over the age of 70 and a half and has a regularly scheduled required minimum distribution withdrawal each year, you may want to get in touch with them and see if they still want to take it for the year or not. If they do not want to take it, they should really contact their record keeper to get that scheduled distribution aborted or canceled for the year or postponed or whatever they want to do to make sure that what's happening is actually what they want to have happen for the year. Okay. In regular years, certainly not 2020, If you are a participant who is over the age of 70 and a half, or actually over the age of 72 now, excuse me, you are required to take a distribution of at least a portion of your account balance. NOVA does monitor these on your behalf, and so we typically reach out in October of a calendar year in order to tell you about this requirement and who needs to get one and how much they need to distribute. Fortunately, you are spared from all of that communication from us this year because, like I said, required minimum distributions are not required for 2020. Another distribution type that comes up relatively infrequently is a qualified domestic relations order, or a quadro for short. So when a participant goes through a divorce, this is a court order that is signed by a judge that allows a portion of the participant's account balance to be distributed to their ex-spouse. Okay, this is the only time that that a participant's 401k account can be assigned to somebody else. So this is a pretty big deal and requires the actual signed by the judge document. Usually a quadro splits the account. It's not always 50-50, but it does split the account as of a specific day. And so what happens is you send NOVA the domestic relations order signed by the judge, and we calculate all the earnings that go to the various people that the account is being split to from the date that is decided by the judge up until the current day, and then we submit the request to the record keeper to split those accounts. As you can imagine, that is not an easy calculation, especially if you have a person who does a lot of transactions. So it is not a one-day process. It is usually not a one-week process. This is a much larger process to do those calculations correctly and to get the funds split appropriately. All right, spousal consent is the next item up. Most 401k plans do not require spousal consent anymore. So if you have a plan that does require spousal consent, you are in the minority. Nothing wrong with that, but it is not a popular thing to request anymore, mostly because it adds a layer of organization or of administrative headache when you're dealing with your plan. So even if you require spousal consent, if your distribution is for less than $5,000, the spousal consent is not required. But if your account balance is over $5,000 and you require spousal consent, then the spouse has to sign off and it has to be notarized before a distribution or a loan can be processed. Okay, so it can be a challenging thing if you have this in your plan. There are some plans that require it. So if you have a plan that was once a money purchase plan, or you had money purchase plan assets merge into your 401k plan, you may be subject to spousal consent requirements. If you are a defined benefit plan, you are subject to the spousal consent requirements. Okay. All right, talking about tax notices next. There's a special tax notice that must be distributed to participants when they get their distribution forms. And essentially what it does is explains to them what each of their distribution options are. So what happens if they roll their money over, what happens if they take their money in cash, and what the tax consequences are of each of those decisions. It also will cover Roth money and whether you take that in cash, roll it over to a Roth IRA, et cetera, et cetera. So like we mentioned before, if you take a distribution in cash, it is going to be included in your taxes for the year as taxable income. There's 20% federal tax withholding that comes right off the top. And there is a 10% early withdrawal penalty if you are under the age of 59 and a half and you take the distribution. If you roll over your distribution instead of taking it in cash, the taxes are deferred until the money is actually taken in cash. You can roll the money over to an IRA or to a new employer's 401k plan if the new employer's 401k plan accepts rollovers. Almost every plan out there does, but there is the occasional plan that does not accept rollovers of any kind. Also worth noting that hardship withdrawals and required minimum distributions have to be taken in cash. They cannot be rolled over. That's just the law. Okay, taking a breather, moving on from distributions into participant loans. So for participant loans, these are different than distributions because, like the terminology says, it's a loan, so the money has to be paid back. But what happens is the participant borrows out of their own 401k account, and that's where they repay their funds to. So the idea behind a participant loan is that it encourages participation. Participants are much more likely to defer money to the plan if they know that they can get to it if they need it. You can make loan provisions restrictive. So for example, most plans only allow one participant loan at a time, but there are plans out there that allow an infinite number of participant loans if you want to get real crazy with it. So you can also limit the reasons that participants can take loans, a whole bunch of other things that you can do if you want to restrict the number of loans that a plan allows and still allow that provision for your participants. Participant loans are not taxable distributions. Because they're a loan and because they're going to be repaid to the plan, the IRS does not consider them taxable income. They do have to be repaid via payroll deduction as long as the participant is on your payroll. So similar to 401k deferrals as being, payroll deduction is the most successful way of getting somebody to contribute to their retirement. Loan repayments through payroll deduction is the most effective way to make sure that a participant makes good on their promised payment schedule. Okay. If it comes out through their paycheck, there's no, well, the check was lost in the mail. There's no, oh, I'm short this week. Can I get you double next week? None of that craziness. It's just coming right out of the payroll every time. Okay. If you want to add loans to your plan or change your loan provisions, that is a plan amendment, but you can talk with your Nova account manager and they would be happy to walk you through your various options and get a loan program set up for you that works to do exactly what you want it to. Participant loans are limited to 50% of the vested account balance up to $50,000. Okay, so and the rules are a little bit different this year due to COVID, but we're going to get to that here in just a moment. So any year other than 2020, participants can take up to 50% of their vested account balance. So notice it's not their total account balance, it is their vested balance. And they cannot take more than $50,000 in a participant loan. If they are a person that takes loans out on a regular basis, that $50,000 limit is reduced by their highest outstanding loan balance during the last 12 months. Okay, so that is a way to keep people from just taking essentially a revolving $50,000 credit out of their account that just keeps that money out. Okay, like I mentioned, Nova does have some defaults that we encourage our plan sponsors to use. Again, these are defaults. Plan sponsors choose all kinds of different things, but just in general, the majority of our plans that do allow loans will allow just one loan outstanding at a time. They'll require a minimum loan amount of $1,000. Our thought is that anything less than that, the fees that stack up when a participant takes a loan just really makes it uneconomical, not in the participant's best interest for loan amounts less than $1,000. We require repayments by payroll deduction, like I said, just because that's an easy way to keep as many loans as current as possible. And we generally do not require spousal consent for participant loans to be taken. Again, all of these are electable provisions in your Nova document. So if you wanted to change any of those, you can talk with your Nova account manager. So like I said, the CARES Act and COVID-19 does change things a little bit for this year. So like I said, typically our loans are limited to 50% of the vested account balance or $50,000, but due to COVID and the CARES Act, loans taken between March 27th and September 23rd of this year The loan limit has been increased to the lesser of $100,000 and 100% of the participant's vested account balance. Okay, just like the CARES Act distributions, the plan sponsor can rely on the participant's certification that they meet one of those requirements in order to take this loan. Okay, so far at least, most of the participants that have taken a CARES Act loan or withdrawal from NOVA have taken the withdrawal option because that is easier than making the repayments on $100,000, and they do still have those 3 years to repay the money to the plan if they choose to. So just talking from NOVA's experience so far, the vast majority of our requests have been distributions rather than loans. Also, it's worth noting that September 23rd gets closer every day. We're just over a month away from that deadline now. The deadline for the distributions, remember, is December 31st. So there is a distinction there that is also worth paying attention to. Okay, a couple of requirements for participant loans that are laid down by the IRS. Loans must be charged a reasonable interest rate. So the general idea is that the interest rate on these loans should not be materially different from the interest rate that the participant would be able to get if they were to go to their bank or credit union or whatever to get an unsecured loan. Okay. Typically for NOVA, that means it's the prime interest rate plus 2 percentage points, because usually prime plus 2 or 3 percentage points is what the commercial market will generally charge for a loan. The maximum loan term is 5 years, unless you're making a purchase of a principal residence. So if you're purchasing your principal residence and the plan allows it, you can take your participant loan for up to 30 years. Although as a plan sponsor, I'm not sure how many people in your company work for you for 30 years, and the thought of keeping an amortization schedule current for that long, I imagine, is a pretty daunting thought. Again, loans should be repaid through payroll deduction on an after-tax basis. So when those loan repayments are taken out of a person's pay, those are after-tax payments or after-tax amounts, and then they are sent into the 401k plan. If you have a participant who terminates before their loan is paid off, the loan becomes fully due and payable when they terminate. Okay, so if you have a participant with a large loan balance and they terminate their employment, voluntary or otherwise, that loan becomes due on that day, and they need to find a way to pay that off, or it's going to be included in their taxable income. If you do not follow the loan provisions, it's what's known as a prohibited transaction, which means that the IRS and or the Department of Labor will come knocking at your door and cause all kinds of unpleasantness. The distribution or the loan is, if it's a prohibited transaction, is actually considered a distribution and subject to early withdrawal penalties, and there's excise taxes involved, and it's generally speaking a pretty nasty thing. There are typically fees that apply for taking out a participant loan. The loan initiation fee, NOVA charges one, and your record keeper will charge one as well. Record keepers will also usually charge an annual or a monthly loan maintenance fee. Both of these costs are charged against the participant's account who takes the loan. So make sure that the participant is aware of that. The loan request forms, whether they're in paper or online, will lay out these costs as well. These should not be a surprise to any participants who are interested in taking loans. And we're telling you this now because we don't want it to be a surprise for you either. Okay, expediting the loan process. Typically, when participants come to you requesting loans or hardship withdrawals or in-service withdrawals, they are trying to get the money as quickly as possible. People don't come to take distributions out of their 401k account just because it's a random Wednesday. They take it because they've got a rent payment due at the end of the week, or they're trying to make the down payment on a house or a car or something. Okay, so it's important for you to know the things that will speed up the process and the things that will slow down the process. So the first thing is you need to understand how your record keeper works. So some record keepers will say that, a loan request that comes in by X time on X day, the check will go out the next day, or it'll go out in 3 days, or it'll go out in 7 days. It varies by record keeper. So you want to know what their standard turnaround times are so that you can share that information with the participant right off the bat. One way to speed things up is if your record keeper allows it, do the loan online. Online processing is much faster than paper form processing. There are less hands that it has to travel through. There's a lot more automation that goes into an online processed loan. So that is a lot faster to get money to a participant. Another thing that can speed up the process is to request that the loan proceeds be sent via ACH instead of a check. A check has to be issued, then it goes in the mail, and then it's up to the mercies of the U.S. Postal Service. An ACH goes straight from bank to bank. It gets there, it's in the account, it's ready to use. So that is also a much faster process than the paper check. And again, communicating this information to your participants when they're requesting the loans or when they come to you with questions is definitely going to save a lot of consternation on the back end when they're like, oh, I actually needed this money yesterday. We want to make sure that they know what to expect when they're making these requests. Okay, so I got time for a couple of quick examples here on the loans. So we got participant A, current vested account balance is $2,000. They're requesting a loan for $1,000 to be paid back in 2 years. The plan document allows for one loan outstanding at a time with a minimum $1,000 withdrawal amount. 50% of the participant's vested benefit of $2,000 is $1,000. So the participant's request would be approved. Okay, nice and easy on this one. Okay, example B. This time we got a $2,000 vested account balance, including a $400 outstanding loan, and they're requesting a new loan of $1,000. This plan allows for 2 loans outstanding, so that's not a problem. They allow a minimum $1,000 loan amount, which also is not a problem. But the 50% of the participant's vested benefit is $1,000. But the available loan is reduced to $600 because remember, we have to cut off the maximum loan amount in the last year when we're determining the maximum. Okay, so the loan amount would not be approved because the maximum loan available for this person is only $600, and that is less than the plan's minimum loan amount. Okay, all right, moving on. So loan defaults, nobody wants to deal with loan defaults. Loan defaults are when participants miss payments, and they miss payments enough so that the loan goes into default and becomes taxable income to them. That can be a pretty big hit to the taxes for a participant, right? So a couple of ways to avoid that is to only allow for payroll deductions for loan repayments. Again, that's the safest way to keep everybody on track. You want to set up loan repayments immediately in the payroll system. So make sure that when you get an amortization schedule after a loan has been issued, that you set it up in your payroll system immediately. Review your start date for the loan repayments to make sure it matches the amortization schedule. Enter a total repayment goal amount. So total number of payments times the payment amount. Okay, and that'll be a total number that you can count down to in your payroll system to know when the loan is paid off. Okay. If a participant has a leave of absence, they are still required to cover those loan repayments. So whether that becomes a point where manual checks are required, or if the participant just wants to wait until they return and then do like make-up payments out of their future paychecks, depending on the length of the leave, that might work out as well. Okay. So if you're not on top of these types of things, it can cost you as a plan sponsor. If you're not withholding payments when you're supposed to be, then you'll be responsible for helping make the loan work again, which could end up costing some money. Okay, so if participants have missed loan repayments for one reason or another, they can do a lump sum of the total payments that they've missed to bring the loan current. Or they can do what's known as re-amortizing the loan. So they can take their loan amount, the accrued interest that they haven't been able to pay so far, and then they can re-amortize that over the length of the loan, essentially increasing their payment amount to stay on track. If a person does get behind on their loan, they do have a grace period to correct it before the loan is put into default, and that is the last day of the quarter following the quarter when the first payment was missed. Okay, so if you miss a payment in, let's say, April, okay, that quarter ends on June 30th, which means that they have until September 30th to make their loan current or it goes into default. Right? Okay, switching gears from loans and talking about vesting, and I've got about a couple of minutes left, so we're going to go through this a little bit quicker than the previous sections. But vesting is what happens for employer contributions only, and it determines how much of a contribution that an employer makes to a participant's account that the participant gets to keep. So each year that a participant is employed with you and accrues a year of service, which is generally speaking a year with over 1,000 hours of service, they accrue more vesting. Okay, vesting applies to things like employer match money, employer profit sharing money are the two main ones. Account types like safe harbor money, qualified non-elective contributions, qualified matching contributions, and rollover contributions are not subject to vesting. So a year of vesting service is calculated on a plan year basis. Like I mentioned, a year of vesting service is credited for each year which an employee works 1,000 hours. Okay. The vesting is calculated from the original date of hire, not the date that a participant becomes eligible for the plan. So that first year is a little bit tricky because it's not on their eligibility date, it's from their hire date. Okay. If you have a job type where you don't track hours of service, the IRS has an equivalency method that we can use to estimate what the hours of service would be for a person. There are some plans out there that use elapsed time to calculate vesting. Elapsed time just means that you count the time period from the from hire date for a year to credit a year of service. Okay, so the number of hours that a person works during that time period does not matter, and it's just a matter of counting the number of years from their original hire date to determine the number of years of service they have for vesting. This sounds easy, but if you have ever worked on an elapsed time plan, you will wish that you had an hours of service plan, and that's just my personal opinion. Okay, a couple of quick vesting examples. You have a participant who's been credited with 2 years of service with ABC Company on a 3-year cliff vesting schedule. So they've got an employee deferral balance of $5,000. They have an employer match balance of $3,000, and they do what's called a 3-year cliff vesting schedule, which means that on year 1, you're 0% vested. On year 2, you're 0% vested. And after year 3, you become 100% vested. Okay. So this person with their 2 years of vesting service is going to be 0% vested in their employer match money. So their deferral is going to remain 100% vested for them. Their employer match is going to be 0% vested. So if they were to terminate employment and take a distribution, they would be entitled only to their employee deferral of $5,000. I'm pretty sure the next slide is going to go through that. There we go. So the total distribution to participant, $5,000. 100% of the match source is transferred to the forfeiture account. Okay. Example B, coming up next, we've got 4 years of service for this one. 5-year graded schedule. So it's 20% vesting accumulates per year, and he has the following account balances: $2,000 in employee deferral, $1,000 in the profit sharing, and $1,000 in the safe harbor match. Remember, we mentioned earlier that the deferral will be 100% vested. The safe harbor match will also be 100% vested. So the vesting will only apply to the employer profit sharing. With 4 years of service on a 5-year graded schedule, that is going to be 80% vested in the employer profit sharing amount. So 80% of $1,000 is $800. So the total distribution for this person would be $3,800. Okay, so here we go laying that out. And then the remaining $200 in their profit sharing money type will be transferred to the forfeiture account. Okay, so real quickly, how do we get out of our most difficult problems that we come into when we're dealing with loans and distributions? Forms not in good order. This happens all the time, especially on paper forms. We want to make sure that the forms have a signature from the participant, that there is a date of termination in there, that the plan administrator, which is typically you folks, have signed off on the form and dated the form. We have had many forms get returned because either the participant or the plan administrator have signed the form but haven't put a date down. Okay. For loans, problems that we often see are the payroll frequency is incorrect. So the participant fills out the form saying that they're paid weekly when it turns out they're paid biweekly. Things like that. That puts them behind right away when their loan gets started. The loan term, the number of years that they want the loan to take for, people mess that up all the time. And the next payroll date is also one that is easily misconstrued to set up people for failure on getting loans running correctly. Hardships, 9 times out of 10, the reason that we return a hardship distribution request is because the hardship documentation is incomplete or inaccurate or insufficient for what the participant is trying to do. Okay. So just make sure that we are doing what we can to get good forms submitted. That gets the distribution funds into the hands of the participants that much more quickly, which generally speaking makes participants happy. All right, talking real quick about cybersecurity measures. This is a time where with more and more people going remote, there are more and more people out there looking to steal personally identifiable information from participants, okay? So working with a third-party administrator, working with a record keeper, there's a lot of personally identifiable information that gets transmitted between the parties, right? So social security numbers, addresses, dates of birth, compensation amounts, etc. So we want to make sure that we are sending all of this stuff in secure ways, okay? So Nova has a secure web portal on our plan sponsor link website where you can, it's called Secure File Exchange, where you can send information to Nova and Nova can send information back to you. We also have a secure email feature that we can send you a secure email. You can reply to that email and that information will be encrypted and to keep it safe in transit. We also do things like we require that a existing authorized signer for a plan is the one who approves that any new person is allowed to access plan information here at Nova. We also do mandatory cybersecurity training every quarter, and every quarter Nova associates are required to update their passwords. Okay, all these things we do to help protect the information that you entrust us with and to keep your participants safe. Okay, CPA credit, remember you're going to get a link after the webinar ends that you'll need to complete for the evaluation or to get your credit, and it's about 1 week before that certification comes to you. Okay, Jasmine, have we had any questions submitted?
Yes, Jason, we did have a few, so I'll go ahead and read the first one. To understand early distribution fully, if I were elected to have my 401k distributed to me and I use the funds to pay off high interest rates, I would have the opportunity not to have to pay taxes. I place those funds back in my 401k account over the following 3 years.
So it sounds like the first half of that question was talking about an in-service withdrawal, and the second half of the question was talking about a CARES Act distribution. So the CARES Act distribution, if you were to certify that you qualified for the CARES Act, like we said, was either you or a family member had COVID, or you've been laid off or had a reduction in work hours or whatever due to COVID, you could take a COVID distribution in cash. You could use it to pay your high interest credit card balance. And if you're able to recoup that money sometime over the next 3 years, you could return it to the plan. just know that that distribution would be includable in your income taxes, at least 1/3 of it each year for the next 3 years, if you went that route. So mostly, yes, what you said in that question is accurate, but there are a couple of things I just want to make clear.
Thanks, Jason. Our next question, they're referring to slide 18, which was on the hardship distribution reasons.
Yep.
Can a plan provide distributions for any of the qualifying hardship conditions, or does the plan need to specify what conditions it will allow for hardship distribution?
Good question. So the plan document, NOVA's plan document, does these are called safe harbor reasons because these are the ones that are explicitly approved by the IRS. So we select all of these in a group with you, like as a default for the plan, if your plan allows hardships. If you wanted to do just some of these or just one of these or something like that, that is entirely allowable. You can talk with your NOVA account manager about making potential changes to your document to accommodate that.
What if an employee wants to pay off a loan early?
Right, okay. So if a participant wants to pay off one of their loans early, obviously payroll deduction is not going to be a good option for that, right? Usually they come to you when they have the check in hand or something like that. 9 times out of 10, without, like if they're just coming to you, they're going to ask you what their loan pay off amount is, and they might be sitting there with their checkbook in their hand, just like ready to hand you a check. What you should do is you should contact your record keeper, because the loan amount that is listed on the website on any given day is not necessarily the same as the loan payoff amount, because interest continues to accrue. So you want to make sure that you contact your record keeper to determine what the loan payoff amount is. You take into consideration any loan repayments that have already been withheld from pay but have not been submitted to the plan yet, and then you can tell the participant what that difference is, which is the amount that they would have to write the check for. Most record keepers, in my experience, would prefer it if the participant wrote the check to you as the plan sponsor, and then you as the plan sponsor included that payoff amount on your next payroll file. But I do know that there are some record keepers out there that will accept a check from the participant to pay off a loan.
Thanks, Jason. Our next question, are there COVID-19 loan request forms in our system, or would that depend on who we use? Census is the name of the company we utilize.
Yeah, so all of the COVID forms are going to be issued by your record keeper. So John Hancock, Empower, Voya, et cetera, et cetera. So they are going to be the people that are going to be in the best spot to get you those forms. If they are unable to provide one or you can't find it on the website, definitely contact NOVA because we deal with distributions like this all the time, so we know where to go to get those forms.
Regarding hardship withdrawal for post-secondary education, can this be used for dependent college expenses?
Yes. Yep. Dependents and spouses can have their expenses covered with a hardship for post-secondary, and participants, obviously.
Thanks, Jason. And we did get quite a few more questions, but since we're out of time, for those that did submit questions, we'll go ahead and reach out to you directly via email with answers. We'd like to thank everyone for attending today's webinar on 401k loan and distribution basics. There will be a survey sent out and a follow-up email within an hour, so be on the lookout for that. The certificates will be sent out in 1 week, and the recording of this webinar will be made available on our YouTube channel by next week. If you have any questions, please reach out to your account manager and they will be happy to assist you. We hope everybody has a wonderful Wednesday.
Thank you, everybody.